Michael Gale from Withum, Smith & Brown, educated at Bucknell, bachelor's in accounting and a master's in taxation at Villanova University. So, if you're looking to set up a company, maybe you're working out of your apartment or dorm at the moment, but if you want to set something up, you have to think about the federal government, the state that you're residing in, and then where you want to set up your entity. Typically, people are setting up their C corporations in Delaware, so you need to worry about setting up an entity number with the federal government, register with Massachusetts, register with Delaware. You can choose what entity you want to use. It could be an LLC, it could be C Corp, S Corp. Basically, that depends on your goals, and if your goal is to grow this company and get some venture capital money, they want you to be a C Corp. You could start as an LLC and convert to a C Corp. I mean, everyone's different, but what we want to talk about today is just sort of general issues in taxation. You have to file a federal return and Massachusetts return by a certain time, right? So it's very important that you get these things done correctly and on time, because you don't want the state to come in or the federal government to come in and audit you. Not because they'll find things necessarily, but your time running a company and growing a company is very valuable. And to do things right the first time is the goal, right? And then you don't have to worry about explaining yourself to these folks. There's also benefits that you want to look for. Now, once you've set up your entity, you're paying your taxes, there's tax credits, a lot of state and federal government credits that you can receive as a company, especially one doing a lot of research and development, building a company. Typically, you can get 10 cents on the dollar back from the government for all the money you pay in salary expense and consulting expense for research and development. So you can think of taxes in a couple ways, but one is get compliant, and then look for ways to save money on taxes and to take tax credits. Yeah, so as far as the resources you have available to you for little or no cost, I mean, every state and the IRS has a website. You can go there, research things like, can I reimburse certain expenses for my employees, or there's publications on the IRS website that explain almost anything you could possibly imagine when setting up a business and setting up policies and procedures for your company. If you're looking to move into a new state, every state website has a section says starting business in this state. There's also a lot of resources online for startups. The Startup Hub, there's many websites where you can go and get your questions answered. Similar to this video. We've got a spreadsheet that gives you the links for all of the state registrations, the state taxes, the federal taxes, about how to set up a company. So for an LLC, an LLC is a partnership. The S Corp is also a partnership. These are meant to tax the individual and not the company. When you're talking about a corporation, a C corporation, that entity, that corporation is taxed at the U.S. rate, typically of 35% plus your state rates. An LLC or an S Corp are partnership returns. Those entities are not taxed themselves. So if that entity makes money, it just flows down to the owners of that partnership, and they include that on their personal return. The same as with a sole proprietorship. All that is just included on your personal return. You don't have to file an entity return. So with a partnership and a C corporation, the partnership return is a 1065 form, the form number. The corporate return is an 1120. Those forms provide additional administrative burdens in the sense that you have to file new returns. But as far as taxation, the partnership returns are not taxed at the entity level. Now, you would think that the common perception is that a C Corp, because the entity is taxed and the individual is taxed when taking dividends out, that's 2 layers of taxation. Why would I want 2 layers of taxation when I can only have 1 layer of taxation in a partnership or a sole proprietorship? And the answer there is that a lot of venture capital money and investors and banks, a lot of these folks like to see C Corps. A lot of investors like to see C Corps. And SCorp specifically has a lot of restrictions on what type of investors can invest in that company. And so it's really about your goals. If you're in this world in Boston where we are sitting today, there's typically a goal of getting funding from an investor, and so a C Corp would provide you with a lot more flexibility there. And so you could have a single person LLC or a multi-member LLC, right? If you're by yourself, a single member LLC, that is a disregarded entity for U.S. tax purposes, and so you do not have to file a return. In that case, it would just be included on your Schedule C of your personal return. To the extent you get a partner someday, that becomes a multi-member LLC. It is now regarded for U.S. tax purposes, and you'd have to file that additional return, the 1065. Sole proprietorship and is simply there's no entity. You're doing business under your Social Security number. You can get an entity ID number, I believe, but in general you can operate just under your Social Security number. So there's no separate entity. You just file the business on your Schedule C. If you want liability protection, so now we're getting into legal purposes, one of the reasons why people set up LLCs or corporations is to limit their personal liability. So if you're just in a sole proprietorship, there's no divide between the company and yourself. So if the company were to get in trouble, and anything from a slip and fall on the front steps of your company to a lawsuit from a customer could affect your personal bank account unless you set up an LLC or a C Corp to legally protect you. And that's why people set those entities up. I'd say these days we see a lot of LLCs and C Corps. We don't see a lot of S Corps because of the limitation on investors. We don't see sole proprietorships because there's no limitation on the liability to your person. And so you're going to typically choose an LLC or C Corp. A lot of the times those are registered in Delaware because that's the most friendly state for corporate litigation. Also, the venture community, investor community, typically like C Corps. So if you think far enough ahead, you typically will set up as a C Corp. If not, then you will. You could obviously set up as an LLC and you can convert to a C Corp at any time. But I see maybe 50-50 on the LLC and C Corps at this time. So double taxation, we referenced it earlier, is applicable to C corporations. So you have C corporations, S corporations, and LLCs. C corporation is a typical, like GE is a C corporation, Walmart, all the big companies of the world are C corporations. You have an entity that is separate from its owners. That entity is taxed. After that entity makes its profit and it's taxed, there's typically some money left in that corporation. That money is often used for dividends. You see it in the stock market, and you can see it with a privately held C corporation, dividends to the owners or shareholders. Once those dividends come to the owners or the shareholders, typically those are always taxed again at the individual level. So as an owner of a company, you'll get the 35% corporate tax rate plus the state tax rate, and then you would also get an individual tax on the dividends. Sure. When you're running a business, a lot of the time you run losses for several years. A lot of the time that's because any revenue that you do make, you're investing back into the company for research and development, improve your product, maybe expand, open new locations. And so as long as you're showing some revenue and you're showing an active trade or business, you should be in good shape. Now there is that the clause about a hobby versus a business. A lot of the times, if you are showing losses for 3 or more years, then typically the IRS could redefine that as a hobby, and what you've been doing theoretically is taking those losses on your tax return. They would then go back and disallow those losses, and you'd have to pay some tax back to the government. And when you're running a company, if in the first years you're putting a lot of money into R&D and you have a lot of expenses without revenue, then you're in a loss. And You wanna definitely keep track of those losses, because, for instance, let's say I lose 100,000 the first year, 100,000 the second year, 100,000 third year. The fourth year I make 300,000. I don't pay any tax on that 300,000 because I can offset it against the previous losses. And so it's important to keep track of all of your losses. Andrew just checked the